So what are they? They're an additional source of financing which is effectively, and I say effectively advisedly, and we'll come on to the detail of that in a few moments, which are effectively junior to the senior debt, but senior to the unsecured debt. They can be either loans or bonds, or indeed in one case they were both, ranking side by side. And they are designed to be attractive to investors who are subject to certain regulatory constraints or who are subject to constraints imposed by their constitutional or fundraising arrangements and which either don't want or can't buy subordinated debt, particularly hedge funds. There's been a huge increase of them in the States, and I think that's why we started seeing more of them in Europe. Just to throw a statistic at you, in 2002 they represented 1% of the US leveraged loan market. And yet, in the first, I think, 6 months of this year, they already represented 7%. 66 deals so far, or 66 deals in June, I should say, in the US, as against 26 in all of 2003. And there have been some European examples of them. In Cognis, there was a 400 million euro second lien tranche. Brenntag had a 60 million tranche, and Springer had a 100 million facility built into it. Oh, sorry. So comparing them to European MES, they're longer dated than senior debt, as European MES is. They're not prepayable while the senior debt is outstanding, and there are generally premia payable on any prepayment in the first either 2 or 3 years, although it's worth noting that those premia tend to be less than the traditional MES returns. They have second-ranking security, and therefore they rank ahead of trade creditors to the extent of the value of the collateral. However, what's key to them from the perspective of the senior lenders is that this is the senior who control enforcement, and the wonderful phrase here is either silent second liens or quiet second liens, depending on what rights they have. And that's really the principal area for negotiation in these transactions, what rights to enforce the second lien holders have. Pretty key, however, the second lien holders do agree not to challenge the priority or the validity of the first-ranking security. Now, the key difference, at least as a legal matter with mezzanine, is that the actual debt itself is not subordinated. All that's subordinated is the security. So the borrowing by the borrower, and indeed the guarantees of that borrowing, are not subordinated. That does have certain implications regarding recoveries from third parties. To the extent that the value of the security is therefore less than the value of the senior debt, the two rank side by side, you might ask how important that is as a practical matter. And to be honest, I think we need to see a workout or two in order to work out the implications of that. Equally, however, because the debts rank side by side, that does have implications from recoveries from third parties. Now, typically in a mezzanine deal, the mezzanine agree that any recoveries get turned over to the senior debt until they're paid over in full. And that would include, for instance, any deal which is done with the shareholders. I don't think that is typically the case in a second lien deal, which does give them some areas for negotiation they didn't otherwise have. In the covenant package, there will be strict limits on the amount of senior and second lien debt for fairly obvious reasons to protect their priority position. And this is really the key covenant in the deal, in as much as this is the practical limitation on the ability to raise further financing, because in practice, the likelihood of the companies which are issuing second lien debt being able to raise unsecured money is fairly thin. They tend to have maintenance-based covenants if they're structured as loans, the same as MES. Again, the same as MES. Their covenant package is likely to be backed off probably 10, 12, whatever the normal rate is, % off the senior level. Again, if they're structured as bonds, you'd expect them to have incurrence-based covenants. The standstill position is interesting to compare with the States. In the US, second lien holders tend to be very careful about giving away any unsecured creditor rights. Their normal position is that we are agreeing to subordinate our security interest. We're not agreeing to subordinate our debt. And as a result, any intercreditor agreement they sign will expressly preserve their ability to act as an unsecured creditor. So, for instance, it would preserve their ability to wind the company up or to sue it. However, that is set against the background of the US insolvency regime. And as we all know, that when US companies get into difficulty, what tends to happen is they tend to go into Chapter 11 at quite an early stage in the process. So in practice, the giving up of those rights is not as critical as it is in a European scenario where most workouts are done outside of a formal insolvency regime. So the deals which have been done in Europe have tended to adopt mezzanine-style standstills and payment blockages. In terms of turnover, by turnover I mean an agreement of the second lien holder to hand over money it receives. They do tend to agree to hand over money they've received which they shouldn't have received, which you might think is fair enough. Query whether they agree to hand over any amounts they receive from third parties. I think logically they shouldn't need to agree to hand over any money they say receive from shareholders. In terms of monies they receive from, say, providers of due diligence reports or whatever, there really isn't a US precedent to guide us, because in the US, report providers tend not to give reliance rights to lenders. The deals which I've seen in Europe so far have tended to allow report providers' money to be handed over to the senior as well. Most controversially, I think the position which certainly the senior lenders are taking in Europe is that if the security fails for any reason, then the second lien holder has to turn over to the extent of the value of the security, which you might think is slightly odd, given that they're not agreeing to subordinate their debt. In terms of release of security on enforcement, which is critical to the ability of the senior lenders to, if you like, drive the bus, as I've seen it written, excuse me. The position which I've seen here is that the second lien holders agree that enforcement of security by the senior lenders will result in a release of their own security. Obviously, they get whatever proceeds are left over after the holder of the first security has been paid off. I have seen it suggested that we might end up moving to a US-style high-yield arrangement where a release is only against a sale by public auction, or possibly against a fair market value opinion. That obviously is going to be very unattractive to senior lenders because of the litigation possibilities it presents for them. In terms of second lien facilities in Europe and the security for them, I think we face the same difficulties here as we face with mezzanine. The general rule of thumb in structuring these transactions is that the more junior debt tends to be used to finance the acquisition rather than to refinance existing debt. The reason for that is that typically it's easier to get security for refinancing debt than it is for debt incurred to pay the acquisition price. That presents a number of problems throughout Europe, as you probably all be familiar with, in terms of corporate benefit, in terms of maintenance of capital issues, in terms of financial assistance. So I think when looking at a second lien deal in Europe, it is quite important to kick the tires a bit, frankly, to understand, if you're thinking of investing in one of those transactions, exactly what the value of the security is. You may well see the transaction structured so that on the face of it, it has guarantees and security. Those guarantees and security will, I suspect, be qualified by corporate benefit issues, by financial assistance concerns, and it's quite important to understand fully exactly the limitations applied to your transaction those limitations affect. And finally, on this topic, the techie issue I mentioned earlier. I'm quite strongly of the view that the correct way to document these transactions is to have a second deal in the way that mezzanine historically has been, with a separate class of voting rights. That is not the way it's always been done. I've seen a few deals with that structured inside the senior transaction without really a separate class of lenders for voting purposes. that does create quite difficult issues if the second lien is, as it typically is, quite a small part of the financing package, because it can then be effectively swamped in voting terms by the senior lenders. So a lot of the ability in those circumstances which the second lien holders have is in fact diluted because they won't reach the required majorities needed to do anything. Just a point to watch out for. I'll flip on quickly to PIK facilities, and I'll run through what their uses are, their characteristics, the terms, although they do vary hugely, and a few important issues in relation to them. The two principal uses for them are to reduce the amount of sponsor equity required to close a deal, and that's because if properly structured, the senior and mezzanine or second lien or high yield investors should be able to treat them as equity. They should, and we'll come on to this in a minute, have no material rights to upset the deal, at least until the senior and junior lenders have basically lost interest in it. That can be a source of contention. The second real reason is to basically achieve a recapitalization at a holding company level without requiring senior or mezzanine lender consent. This depends really, the feasibility of this depends on the provisions of the change of control clause in the loan agreement. Quite a lot of those clauses simply deal with voting control. So a change of control is triggered if the sponsor ceases to own the majority of the share capital or the voting share capital of the vehicle or the ultimate vehicle at the top of the chain. Now that's fine if voting control is what the lenders are interested in. And that may well be what they're interested in. Maybe what they want to know is that the sponsor is the person who is able to make the operating decisions relating to the group. If, however, they want to go a bit further and they're concerned about the willingness of the sponsor to put up more money in a downside scenario, then I assume the sponsor is more likely to be prepared to do that if it's likely to immediately lose money if it doesn't. Remember that most of the so-called equity in these deals these days, and has been for some time, has been put up by way of subordinated loan stock, usually for tax reasons. What I have seen is proposals to essentially refinance that loan stock at the top of the chain with a PIK instrument, thereby effectively giving the sponsor the return on all or part of that PIK instrument, but the sponsor retaining all of the voting capital. So in those circumstances, if your change of control clause says you've got to retain 51% or whatever the right percentage is of the voting share capital, there's no problem. If that's what the banks are happy with, that's fine. But I think for the senior lenders out there, you just need to think about what you're looking for from a change of control clause. I think it's also worth mentioning that at this stage of the evolution of the market, we have seen a tremendous range of PIK facilities, from facilities which are effectively junior mezzanine, which are fully secured, which are third ranking, admittedly, but are fully secured, have acceleration rights at the end of a standstill period. At the other extreme, we've seen PIK facilities which have virtually no rights other than an ability to prevent the sponsor taking money out in a change of control clause. There does seem to be a huge variance in what is being offered out there, presumably tailored to ultimate investor demand. I started jotting down a list of what I saw the characteristics of these things and where I saw there was an agreement in the market as to the terms of them and where the market seemed to diverge wildly. In terms of characteristics of them, they're non-cash pay, although I have seen a few which are pay if you can after a limited period. They tend to carry high rates of interest on a roll-up basis and sometimes warrants. They are usually, although in the junior mezz style deals I mentioned, not always, structurally and contractually subordinated. And they're designed to enable the senior and mezzanine lenders to treat them as equity. However, the conundrum here is that in order to give the PIK note holders some real value in their instrument, they do need some mechanism to pressurize the equity. And I mentioned earlier the difficult part in the negotiations of a second lien deal in terms of at what point the second lien holders can exercise rights. Well, it's the same issue here, but probably a little bit further down the chain, about at what time they can start making life difficult for the equity. From a senior perspective, they do need to be toothless, therefore, but from a PIK note holder perspective, they must have what I've written up here as a nasty bite, an ability to get difficult with the equity and potentially deprive them of the value of their investment, since I think in a true PIK note deal, the PIK note holders are looking to sponsor support if it starts going wrong. They're provided by the market and not the sponsors, and there may be the beginnings of a movement towards a more standard package. So where is the market? I think there is an acceptance that they are structurally and contractually subordinated. There is an acceptance that they're longer dated than the senior and the mezz deals. And there is an acceptance that interest rolls up on a semi-annual basis, although I have seen it quarterly in a few transactions. After that, people seem to start moving apart quite widely. I've noticed a trend towards high-yield style covenants, particularly if there is a high-yield instrument in the structure. But some of the admittedly more junior mezz style transactions do carry the sort of senior bank maintenance covenants. There is a measure of agreement that they don't carry maintenance financial covenants. And as mentioned earlier, some of them carry very limited covenants indeed, essentially limited to change of control and restricting payments to the equity holders. We mentioned guarantees and security. There's generally no guarantees or security from subsidiaries of the PIK note issuer, and I think the senior and mezzanine lenders would object quite strongly if there was, unless they are visualizing the transaction as essentially a third tier of mezzanine debt. In change of control terms, in some it's a default, and as I mentioned, change of control is, I think, a pretty important issue for a PIK note holder, because they may have no contractual right to support from the sponsor if the deal starts going sour. But the ability of them to effectively deprive the sponsor of their investment by taking action either against the issuer or, if it's granted security over its immediate subsidiary shares, by selling those shares so as to effectively cut off the investment from the sponsor is a very powerful weapon for them. So in some it's default, in others it requires the PIK issuer to make a 101 purchase offer in a sort of high yield style. A good number of them have no call for periods extending up to 5 years, and quite often with high yield style declining redemption premia thereafter. Some permit redemption during that no call period from additional equity, or occasionally only from IPO proceeds. And some permit redemption of only 35%. Now, this is obviously quite an important issue for a sponsor if you're looking at how to structure a deal in terms of your anticipated horizon for exiting the transaction. Towards the junior mezz style end of the spectrum, you tend to get the 3-2-1 prepayment premium we all associate with mezzanine transactions. Just to wind up, before you probably heard enough of me by now, the important issues, I think, the key issues about PIK facilities are firstly, from a senior perspective, whether they're acceptable at all in the context of that particular transaction. Can they get comfortable with there being a possible recap in the future? If so, fine. If not, then people need to start reading the change of control clauses pretty closely. The second point is at what stage the note holders can exert pressure on the issuer. And I've seen different reactions to this question, but should the note holders be able to get support, should they be able to get repaid from the shareholders, at least in part, in order to keep them quiet as part of a restructuring process? Now, some senior lenders have said, well, yes, they're not part of our credit group. We've not got credit approval for sponsor support. We're not relying on that. And others have said, well, no, there's only a limited pool of cash which is ever going to come out of the sponsor for this transaction. So we don't really want any of it going to the PIK note holders first. So different views from different institutions, or certainly from different people, I think, sometimes within institutions. And finally, pretty critical to make sure that there are only remedies at a level above the senior and mezzanine lenders. They should have no ability to attack any entity within the bank group. Thanks very much.
Now we have Gide are going to speak about securitization in LBO financing, and Eric and Michael, I believe you're going to divide this up.
Yeah, I'm going to kick off with some general threshold issues and try and identify one or two preliminary matters which have to be considered at an early part of an LBO financing, and then Eric's going to pick up on some of the aspects of debt pushed on in securitizations. As a preliminary comment, someone over lunch said to me that there is no innovation in LBO financings, and that's because it suits everyone for there to be no innovation, especially the banks. The private equity sponsors get their borrowing, and the banks can maintain a sort of status quo. I'm a lawyer acting for both sides, so I don't comment on that. But I think when you listen to Tim's presentation, and when you look at some of the points we'll raise in the context of securitizations, we would have to say that the market is moving, and there is a degree of innovation purely because of the cost of capital considerations, in LBO financings. The acquisition price paid in an LBO will clearly depend on financing costs and refinancing costs. From our experience as lawyers, that's what we are seeing as becoming a considerable discussion point and negotiating point at the very earliest stages of the LBO process. In support of that, I'm reminded of a comment from a member of Erasio's executive board after they did their FRECA securitization, and that has stayed in my mind since. He said, the weighted average margin of the securitization costs 1/3 of the leverage buyout approach, excluding fees. And including fees is about half as expensive. So the cost of capital consideration is causing everyone at the table, and particularly the private equity sponsors, to try to assess what can save them money. Now, how does a securitization fit within an LBO financing? I'm aware that there haven't been a huge number of these in France, but the whole business securitization model has been quite popular in the UK, and it has been very effective. Effectively, it does not replace the LBO financings, it runs in conjunction with it. It is a process which starts from the beginning. It should be envisaged at the outset of the transaction, and essentially, if it can replace the bridge financing, that's how it should work. It is not going to take out the senior debt, it's not going to take out the tranche A or the tranche B or C loans. By way of example, again, in FRECA, the securitization was used to repay a 420 million bridge loan out of a total of 805 million acquisition facilities. The securitization can also increase the level of debt pushed onto the operating companies and reduce the level of debt at the holding companies level. That clearly keeps everybody happy, and especially the private equity sponsors. The big $64 question in this whole field is what assets or what LBO deals are amenable to securitization. To follow on slightly from what Tim said earlier, that is still something that is being discussed and assessed by the market. I don't think we have a clear view. Every deal has to be assessed on an ad hoc basis. The assets are different, the cash streams are different, receivables are different, so people have to look at every deal and try to decide what they think works for them. Clearly, in the UK, the whole business securitization has worked for the hotels business, cinemas, and into such a diverse field as funeral undertakers. In France, I'm aware that so far it has revolved around FRECA, which was a leasing business, And obviously, where you have a predictable and stable contracted cash flow basis, that's quite amenable to a securitization. So is securitization viable for all LBO financings? Probably not. It is undoubtedly complex. It is undoubtedly expensive. I can assure you that the lawyer's fees for securitizations are no less than they are for straight LBOs. The figure that people generally have in mind, or the rule of thumb that people seem to have in mind, is that you have to be thinking of a securitization of around 200 million euros before it all starts to become economically viable. Remembering that on a securitization, you're going to have a lot of other people coming to the party. You get into a lot of conversations with monoline insurers and rating agents. They all instruct lawyers, and they all have to be paid. And depending on the complexity of the securitization, that process can run for quite a while. So it is very well suited for large LBOs with certain appropriate underlying assets. It may be suitable for mid-caps, but there is a point whereby the economics of the deal may prevent a securitization taking place. Clearly, there are also timing implications. For any of you who have been familiar with securitizations or worked in this market, one of the difficulties is that it's a public deal. There are listing considerations. There are a whole variety of parties to the transaction. It may not just be as easy to control as a bank syndicate. And some of you may find that somewhat of a non sequitur, because bank syndicates can be difficult. But when you're dealing with a number of wholly independent parties who have a different stance and a different interest in the transaction, such as a monoline insurer, the transaction can become protracted. So there are timing implications, and they have to be recognized from the outset. The principal advantage of the securitization for the borrower equity sponsors, the ability to issue investment-grade bonds. Again, using Frick as an example, there were 2 tranches of AAA-rated notes. Now, coming out of an LBO where the traditional debt has been issued via high-yield bond, usually without any form of rating or a non-investment grade rating, that is a considerable achievement. And clearly, investment-grade bonds means cheaper debt, which means more debt, which can mean less equity. And that is of interest. From the private equity side of the deal, that's clearly of interest. I'll just turn into the next page, Humphrey, looking at just to identify 1 or 2 of the issues that need to be thought about at the early stages of an LBO. And you will see that most of this is common sense. There's no great magic to it. But the sooner you can identify that a securitization is possible or is the goal, then the better for everyone. Once the data room is available, if you can get and conduct some form of due diligence on the underlying contracts to see, is it really feasible? What appears on an initial balance sheet as being a feasible securitization may not be feasible once you start to look at underlying contracts and assets. It may not be what everyone is concerned about at that time, but if someone or some member of the team can begin a securitization analysis, it will save pain at a later stage. Clearly identify securitization as a refinancing option in the commitment letters and term sheets. Put it on the table as an option. It doesn't have to be the exclusive option. It doesn't have to say that there is no possibility of high yield bonds, second liens, whatever, but just put it on the table. And thirdly, if you are doing it as a takeout of a bridge, make sure that it is clearly envisaged and expressly dealt with in your underlying bridge or other facilities. The reasons for this are quite simple. If it is not envisaged at day one, the traditional complexity of the LBO financing will effectively strangle a possible securitization. The need to go back to the banks, the lenders, as a group, to get consents and permissions to make changes to the intercreditor arrangements, security packages, etc., to release the asset stream to facilitate the securitization is too difficult. It is a complex and time-consuming process, and this is just another element which effectively can kill it. The biggest fear as well is that once you start to rework or reopen intercreditor arrangements and security arrangements, you can reopen old and potentially nasty negotiations that had to be dealt with under the timing pressures of an LBO financing. When you come to do this via securitization, there is not a gun to everyone's head in the same way, and so it's best to be avoided. So envisage it from day one, build it in. You don't have to use it, it doesn't have to be used, but it's from the bank's and the borrower's perspective, it's better that something facilitates it. I'm very, very conscious of time here, so let me just focus on a couple of points. When people start to analyze the securitization against LBO financing argument, and again, it's important to remember that the securitization is part of the LBO financing. It's not intended to replace it. It's just one element of the refinancing options. Change of control is always a bone of contention for all parties to the transaction. I think it's worth saying that in classic LBO financing, a change of control usually triggers mandatory repayment provisions, events of default, and other cataclysmic events for a borrower. The banks clearly want to be protected. They've got into bed with a certain group of equity sponsors. They want to be protected. In a securitization, the change of control tends to be dealt with in a slightly different way, because the creditors of the securitization, i.e. the bondholders, are not keeping a weather eye on the private equity sponsors. They are looking at their securitized assets and the income stream that comes from that. So there is a difference of perception and emphasis. The monoline insurers and raters will look at the income stream and the assets, and that's what the bondholders look to. So there is a change of emphasis when it comes to change of control positions. One of the other big concerns or increasing concerns in LBO financings seems to be the question of dividend distributions. Clearly, it's a key issue to the banks that no dividend distributions or limited dividend distributions go upstream and out of the structure to the equity sponsors until they have started to be repaid. Securitization can facilitate that to a slightly greater extent by building in a cascading waterfall whereby once the bondholders are paid, once certain cash reserve accounts or other credit enhancement features are dealt with, any excess cash can be paid out. Clearly it's a subject of negotiation, but the bondholders get comfortable with the fact that the monolines and the raters are comfortable with cash leaving the structure. So there is that degree of flexibility. Finally, the nature of the covenants in an LBO financing and a securitization, again, have a different emphasis and a different priority because of the aim of the parties and the aim of the creditors. In the LBO financing, they tend to be complex and onerous and contain a series of restrictions in everything from indebtedness to investments, asset disposal, negative pledge, a myriad of financial covenants, all of which are subject to partial exemptions or partial carve-outs, but they're quite onerous and people have to work with them for the first period of time. The nature of covenants in a securitization is coming from a slightly different priority and a different emphasis. First of all, they are keen to facilitate the continuation of the business, and by establishing borrowing-based requirements and borrowing-based conditions, they can allow the business to grow as long as they can allow the borrowing base to develop as long as the business is growing. If there's a contraction in the business, obviously the borrowing base doesn't grow. Secondly, the nature of covenants in a securitization are focused on not just hitting a distress situation, but come from the position where the monolines and the raters are focused on an insolvency event. They're built in as early warning systems. They're not necessarily built in with the same priority or emphasis as the LBO lenders. Now I'll quickly pass you over to Eric, who will look at some of the aspects of the debt pushed on.
Yes, I will quickly, because I see that the time is running, review some French particular legal issue in connection with all business securitization with financing LBO transaction. In fact, our experience is mainly based on the Fréquin case, but there are several cases which are today under review, and there are several equity sponsors which are interesting to refinance existing LBO financing through all business securitization. As Michael said, it's mainly today, to be honest, in the leasing activities that we see this type of reflection from the equity sponsors. The principal, I would see, legal difficulty we face when we try to refinance an acquisition date through whole business securitization is, by definition, you put the date at the level of a target company or in a SPV, which is deemed to be a bankruptcy remote vehicle. And you have to upstream the money, you have to upstream the proceeds of the securitization transaction up to the acquisition vehicle. And so that's all the problematic, as Michael said, of the debt push down, which is a quite difficult problematic to solve. And if you have not enough distributable reserve, or if you don't have the ability to make any capital reduction, it would be very difficult, to be honest, to do successfully a whole business securitization in order to refinance the acquisition debt, because you will not have, on an accounting point of view, a legal point of view, the ability to upstream the cash. And for example, what makes in the Fréquin case the whole business securitization quite easy is that most of the acquisition price was in fact intercompany loans, which were already at the level of the target companies. And so what has been financed through the whole business securitization, it's not really an acquisition debt, but it was the intercompany loan, which was part of the acquisition price of the group, but which was not, legally speaking, acquisition debt. So that's the main difficulties. Otherwise, there is no really other legal issue. French financial assistance rules is not, doesn't prohibit the whole business securitization, because as we will see, you will lodge all the securitized assets in a SPV, but you are not taking any kind of security in order to secure the acquisition loan, or you are not making advances from the operating company to the holdco in order to refinance acquisition loans. And that are the two operations which are prohibited by the French financial assistance rules. The second queries you can have on a corporate law point of view is the misuse of corporate assets, on the other side, which can be an issue because by definition, you know, the purpose of the securitization, the whole business securitization, is to put all the valuable assets, mainly the receivables and also the assets, for example, in the example of Fréquin, it was the trucks, in a SPV, and to use the SPV only as a company which will be dedicated, in fact, to the bondholders. So in fact, you are extracting from the operating company all the valuable assets, and in the operating company will remain all the liabilities. So that's true that you can consider, if you are third-party creditors of the group, or if you are an employee of the group, you can consider that it's a way, you know, to segregate the valuable assets of the group in a SPV, and this SPV will be used only for the interest of the bondholders. But the view which is generally taken in this kind of transaction is that the corporate interest of the group as a whole and the economical benefit that the group will gain from this transaction could justify to put in place such a scheme. So generally, the problem of misuse of corporate assets, which is a very sensitive issue under French law, is not an obstacle to this kind of transaction. So with respect to the debt pushdown, I think we already discussed about that. So here you have a typical structure of what will be a whole business securitization in a LBO transaction in France. So you have the SPV. The SPV will own what we call the securitized portfolios, so all the assets which are subject to the securitization transaction. The SPV will receive loans from a pool of banks, And this loan will be with, of course, security interest. So, for example, we will use for the receivable the scheme of what we call the loi d'Ailly in France. So all the receivables will be assigned to the banks, and the banks will take a pledge on all the assets of the SPV. This SPV will be a shell company. We will see that it will require to meet a certain number of criteria in order to be seen as a bankruptcy remote vehicle. And the receivables, the loans of the bank to the SPV will be assigned to the investors. The investors are, in fact, the bondholders. So in France, you can use the scheme of the FCC, which is the French securitization vehicle, the Fonds commun de créance. But you can imagine that it is an offshore securitization, so it can be any kind of SPV in Jersey or in other jurisdiction. The operating companies, which are the company, in fact, for example, in Fréquin, which really do the business, which are doing the maintenance of the trucks on a daily basis, will continue to serve the SPV, and so in order for the clients, for example, the lessee to have exactly the same quality of services, the operating company will continue pursuant to services agreement to maintain and to serve the SPV for all the technical feature which will have to be performed under the lease agreement, and that the SPV has not the possibility to perform because by definition the SPV has no employee. The SPV has only assets and loans. And so you will have also a backup servicer, which is very important in a whole business securitization. For example, when the operating companies will be in default, you have to find someone who will have the abilities and the credibilities to replace the operating company in order to continue to maintain and to perform the technical services on behalf of the SPV. So the basic step in order to put in place a whole business securitization is first of all to establish a special purpose vehicle. So we can go to the slide just after. What is important for the SPV, it's to be, because it's the basic and the first point in order to do a whole business securitization, is for the SPV to be what the rating agency considers as a bankruptcy remote vehicle. That maybe it's a bit theoretical, in particular in the concept of French bankruptcy law, but the SPV has to be seen by the rating agency as completely waterproof to any kind of bankruptcy, which means that if, for example, the operating groups fall bankrupt, the SPV can still continue to operate. I think we'll fully agree as practitioners that it's maybe a bit theoretical, but it's the way the rating agencies are reasoning today. So you need, in order to achieve this goal and for the SPV to be completely bankruptcy remote, to meet a certain number of criteria, which has been defined by S&P, Moody's, and the rating agencies. So you will need to have independent management, for example. You will also need to have independent financial auditors between the SPV and the operating companies. You will need to have non-recourse clause from any potential creditors of the SPV. And that's why, in fact, it is quite difficult, in fact, and quite cumbersome to put in place because, for example, just to obtain a non-recourse clause from the third-party creditors is something which is not easy to obtain. So that the first step is to put in place a bankruptcy remote vehicle. Afterwards, the second issue is how to transfer the assets. It's not possible under French law to assign the receivable on a case-by-case basis because in that case you have to follow the rule of the French Civil Code, and you have to make a service by way of a bailiff, a huissier, which is quite cumbersome. So generally what we use, it's a kind of spin-off or contribution regime. So what that means, a universal transfer of patrimony, and so you don't require any consent of the, for example, of the lessee in order to transfer the assets. I think we can maybe go directly to the slide C.1. So the operating company will continue to serve the SPV. through a maintenance and servicing agreement. There you have a tricky issue, which is a labor law issue. It is a famous article in the French labor law code, which is article L122, which is to know when it is a provision of the French labor law which says that if you transfer the activities of a group, for example, of a company, you transfer automatically the employees which are related to this activity, which can be detrimental, of course, to all business securitization, but because it will mean that all the employees of the operating company will be automatically transferred in the SPV, and in that case, it would completely destroy the bankruptcy remoteness of the SPV. But the view which has been taken in most of the transaction, and it was the case in the Fredkin transaction, is that for various reasons, they should not have, there is no risk of automatical transfer of labor contracts to the SPV. But that's, in fact, one of the most tricky issues is this labor law issue. Afterward, and maybe it's the last point I would just mention, is the backup servicing, which is also quite a difficult issue to solve because you have to find someone which has the credibility vis-à-vis the rating agency to substitute the operating company and to continue the business in case the operating company are in default.
Thank you very much.
Just wanted to come back to one or 2 points, basically. I've really appreciated the presentation, the legal presentation. But just wanted to have perhaps a through regarding the interest of these products. Are there innovation? That's a real question. And what's their future? First, are there innovation? I think that we can split the product in 2 types of product. The first one, which are really linked to the LBO market, and that's the second lien, the PIK notes, the new tranche D, which are basically source of financing from NewCo in order to buy a target company, which are really LBO financing. Are there innovation? Not really. Basically, we are actually trying to split through additional tranches existing debt. That's we have the senior A, B, C. Now we are creating the D. We have the senior on the subordination. Now we are creating something in between, so pari passu financing, but second secured on a security. So I really think that these products are not driven by the logic of the LBO itself, i.e. is the company sufficiently cash generative to upstream and reimburse the debt, but they are clearly driven by the liquidity of the market. So we are splitting and resplitting the debt in order to serve the demand of different type of people. So what's the future for this product? I really think that they are conjunctural products, that's structural product. So I do not really think that they have a big future, notably in France. And I just want to have a quick comeback on the second lien. Second lien is basically a tranche C plus 1 year with the second subordinated security package. What's the value in French of a second subordinated security package? Actually, we are saying that for 1 year plus the second subordination package, we are giving 100 bips. Knowing that between a tranche B and a tranche C, we are giving 50 bips. So the second security package is valued 50 bips. I let you imagine what is the value of a second security package, knowing that I think that most of you know what is the value of the first ranking package in a NewCo in France. Let's go now perhaps on the second part of the presentation, which were securitization. And I think that there are other parts of this kind of product, securitization, but also the split between OpCo and PropCo, i.e. splitting the assets, trade assets like this one, or splitting real estate through an OpCo and a PropCo company. Are there innovation? No. Why? Because they are already existing in other markets. So they are not innovation. And basically they are considered as helping the financing because the target has not used them before. The securitization of Fredkin has been used for the LBO, but if the management has done it before, they will have not used it. On the Rexel, which is a current LBO deal, we know that there is one, and that's a lot of questions there. What can we do with it? If you have an hotel business and you split the hotel business in a cash flow transaction and a real estate transaction, then what do you finance? We usually finance both. And now, as we have more and more good professional, we are financing first the cash flow business, the name is the LBO, and then the real estate business, because we know that on a real estate basis, you can have 12, 15 years financing that are not accepted on the LBO market. So there are non-innovation. They are only using existing product to help the LBO financing because they have not been used before the acquisition. So, as a conclusion, I think that we can find a lot of innovation which are known. At the end, there is only two products, senior and subordinated.
Yeah, will you thank the assembled panel? Are there any questions quickly? I think we've got time for 2 questions, otherwise... Okay, no questions. I just have one question to end up with the panel, very briefly. Just where we are in the market at the moment. It seems that, should we say, there's a lot of institutional investors coming into leveraged loans with perhaps without the credit skills that maybe some of the banks have had. And the last time we saw this in, should we say, credit derivatives, it led a couple of years down the line to some very painful situations. And I imagine our friends on the legal panel will have to be revisiting their documents as they work out whether the junior liens and mezzanine, who sits where, as it's all sorted out. Gentlemen, thank you very much.